Think about that same 1 minute candle as a weekly candle and apply the same logic that I outline in my 1 minute setups. Apply that to that weekly chart. It just takes a whole lot more time to submit to it. So when we're looking at a weekly chart, we're not just trying to guess on the next candle without any kind of logic or rationale behind why it should go up or down. We're looking at where has it been? Did it just take sell side? Has it taken sell side and has yet to trade up into a sell side imbalance, buy side inefficiency? Or has it taken a level of buy side on the weekly chart yet? If it hasn't, guess what? It's likely to continue going up. So that's how easy it is for me to say, I expect this week to have a expansion on the upside on the weekly chart. So if that's the case, that makes me trust initially going in, I want to be in a buy model. So my weekly analysis is framed on, I predominantly want to put my larger positions if I'm going to be trading intraday. I want to be focusing on being a buyer, and I'll do full maximum leverage if the trade is viable. It doesn't mean I won't sell short. It just means that if I do sell short, I have to do half or less than what my full position would be on if I was doing a long in a buy model. I'm going to say that again because you probably just didn't even listen to it. And it doesn't mean anything to you because you want to hear something else. But what I just gave you was gold. If my bias for the week is bullish, my largest leverage, pyramiding, building up, using the largest positions I can put on initially and keep adding as equity allows me to do so, I will do that in long positions. If I'm going to go short anytime during that week, I must be at 50% or less of the largest leverage I would use as a trade that week, because I'm going against what? I'm going against the order flow on the weekly chart. So I'm already building in and tamping down the likelihood of a big drawdown because I'm not opening myself up to potential losing trades with maximum leverage. Just because I'm good and nimble intraday, I'm cognizant that I can be wrong. So I build in these safeguards as best as I can and still be able to engage a short position if I'm in a buy model. But I'm not going to hold on to those shorts very long. I'm going to pick the easiest short direct run to a target and be done with it. And it might go many times farther than where I get out at. And I don't care because I'm going to go right back into looking for the next run on the buy side. You see what I'm saying? I'm filtering out the best of the best. But if I want to participate in a bullish market but sell short, I'm building in all of these ideas that would limit my exposure but still allow me participation. But also reminding myself I'm selling short in a market that I know is more likely to go higher. So I don't want to overstay my welcome. And what does that mean? Holding on to a trade too long or turning it into a swing trade. Or, oh, I was wrong about my weekly analysis. So now I'm going to hold on to this longer and look for even bigger objectives and move my limit orders down farther. And then have it turn against me and stop me out. Even if I've taken partials, I don't like that feeling. I like being out when I want to get out, and I don't mind leaving some meat on the plate. Everybody's got to eat, right? So you're referring to that weekly chart and defining whether or not you're going to be in a buy model or a sell model. And that, again, is defined by, do you believe the largest expansion from the open is going to be up or down? You're not trying to predict that weekly close. That's very liberating. When you come to terms with that, it's not complicated. All you're doing is you're subscribing to the same things that we look for in these intraday charts. When the market's still drawing towards a old high or relative equal high, or if you're bearish, let's just say the weekly candle, you're expecting it to go down, the larger expansion going down, because it has recently, in recent weeks or in months, it has taken buy side and it's been dropping. And you can see clearly it's reaching for an old low, or it's about to reach into an imbalance, a buy side imbalance, sell side inefficiency. If it hasn't reached into it yet, then that means what? I'm going to side with the likelihood of the next weekly candle or the one that's about to open up tonight and I'm not saying this is the case for this particular week, I'm just giving you the routine as what this topic is, then in those instances, I would be in a sell model. That means I would be doing the largest position in leverage on my shorts. If I'm selling short, I'm going to be willing to use the largest leverage that's available to me. But if I go long anytime during that week, I have to be at 50% or less, whatever my largest maximum leverage would be if I was going short in a bearish week. Okay, very, very important. Very, very important. Those things helped me a lot in my 6th and 7th year. Once I figured out what I was trying to do, that kind of kept me from wrecking myself, because it would be harmful for me to just, I guess not, no, to eliminate the idea of getting drunk with the volatility of buying and selling, because I can do both just about any market condition, unless it's a one-way straight, rip rate from like a CPI type event. you're not doing both directions in that. With those instances put aside, I can buy and sell in a market condition pretty much intraday. I can do both sides. But just because I can, does it mean that I should just do it because I can? No, I want to maximize when it's on the right side, when it's in line with that weekly expansion, because I'm in line with the large flow. Large institutional order flow on the weekly chart, if it's bullish, or if I'm anticipating it to be bullish, I want all of my emphasis on being long and the leverage behind those trades to be at the maximum there. I don't want to be maximizing my risk and use the largest leverage in a time when I know in my analysis that it's likely to go higher based on the weekly analysis. I don't want to be going short with the largest leverage, because what I'm doing is I'm inviting the market to whip my ass and to do it the best way it can with the maximum effect. So I want maximum effort on my side. I don't want maximum effort on the risk side, where it could punish me, much more than I would want to suffer. So that's the reason why I do that. But when I go through the economic calendar and I remind myself of what I'm looking for and when the volatility should come into the marketplace, when does those high impact or medium impact news drivers come in? And then I'm waiting for that to occur. If my weekly analysis is aiming for or indicates to me through my own interpretation that it's bullish and I'm in a buy model, I prefer to see some kind of bearish drop at that medium or high impact news driver, preferably into some kind of buy side imbalance, sell side inefficiency, or below relative equal lows, or a single 15-minute candle low. Now, 15-minute is my bellwether. Like, I could trade everything in every model that I know. I can use just a 15-minute candlestick chart and do everything I can do, period. I don't need to drop lower, and I don't need to go any higher. I could just simply trade off that. That is not an invitation for you to say, okay, ICT said that, so now that's what I'm going to do. Your bellwether might be an hourly chart. It might be a 5-minute chart. It might be the daily chart. It might be a 4-hour chart. Don't let me, as your mentor, influence you and you copycat every single thing I say I do. That's the worst thing you can do as a mentee with anyone. You have to bring your own personality, your own influence, the things that are meaningful to you, your signature, your fingerprints. They have to be all over this. You can't just say, I took ICT's 100%, everything he said verbatim, and now it's mine. It might be for some of you, but I don't want that. I'm not trying to create copycats of me. I'm interested, very, very interested to see how all of you adopt this idea and formulate your own approach using the tools and concepts, because it's all going to be slightly different, and you're all going to get a unique result, and you can all be positive. You can all be making money on the same day doing different things. That's the beauty of this. It sounds like it can't possibly be like that, but it's exactly how it works. And vice versa. Sometimes you'll have winning trades and other students that will be doing this very same thing you're trying to do. They'll have the opposite result because they're bringing in their problems, like I mentioned yesterday. So back to the routine. See how easily I could have went down some rabbit trails there. I actually listened Hear that? I have a bullet list here I'm going through, so try to keep me on point. It's funny, when I have a deadline, like yesterday, my wife said, "Look, you got to do this. You got to be real quick." And I just went on and went on without having anything written down. Today, I have the run of everything. She's not here, and she probably won't be home till tonight. And I made a bullet point list of things I wanted to cover, and I don't know. I should have did this yesterday probably, but whatever. So you want to review what you thought was going to happen on the weekly candle. Go revisit that. And here's something also you want to do. You need to have a pen or pencil, some kind of writing instrument, and a pad next to you while you're trading. Because on that piece of paper or that pad, you have your weekly analysis, what you think it's likely to draw to. Because here's the benefit of doing that. If you do not have the expectation of where that weekly chart may be reaching for, you might get completely out of a position that's running right for that and leave 30, 40 handles if you're in S&P, or 80 pips in some instances on a Forex trade, because you just felt like it was time for you to get out and you abandoned where you thought that weekly candle may be reaching for. When I was a younger man, I learned a very hard lesson doing that month after month after month of knowing where it's likely to go, but growing in my trust to get to the point where I can say, okay, I'm going to leave something on. And how do you do that? Take as much as you can off and leave the smallest portion you can leave on a trade open until it hits it or stops you out. That's the way you get to that trusting factor. How do you get through learning how to hold on to these trades to get to these targets, ICT? Because if I was up a little bit here, my mind would say to me, let me get out of this because it's uncomfortable and I'm scared it's going to turn into a losing trade. How do you get through that? You get through it by holding on to it. You put your stop in a position where preferably it doesn't gap up above your entry, and that can always be a risk. Every one of these markets can do that. So in that regard, stop losses won't work. But barring those instances, your stop loss moved into a position where if it moves up to you and before you entered, or better than where you entered, in other words, if you were short, your stop loss is below your entry, you are sitting in that position there and you have the smallest position open and you hold for it to hit your target and you don't trail your stop loss anymore. You just let it go. And you grow in confidence over months and years, folks. It takes years. These yahoos out there trying to tell you can learn this stuff in a couple months or a couple weeks or a 1 week boot camp are full of shit. Okay. You can't. You cannot teach somebody how to get a 200-to-1 fucking trade, okay, in a 1 week fucking boot camp. And they're teaching you trading and they're only showing nano lots in their fucking live accounts. Get the fuck out of here. But you're reviewing that weekly candle analysis and referring to that economic calendar. So that way you know the stage is set and you're looking for something opposite to what you anticipate in terms of directional bias on that weekly chart.